Okay, so we're going to spend some time talking about finance, and I know whatever it said in the write-up leading up to this presentation, that's not what we're going to talk about. Because when I was putting together my notes and things, I decided we were going to go in a different kind of direction. We're going to talk about finance, particularly from an investment perspective, what to expect. We're going to talk about stocks. We're going to talk about convertible notes. We're going to talk about term sheets. All the things that you have to understand in order to be able to play in this wonderful world called entrepreneurship. Okay? How many of you have actually raised capital for your business? Okay? Tell us about that experience.
It was very, well, it was easy in that sense because the guy really liked my thing, but outside of that, I hadn't raised any money out after that. It was very difficult.
Tell me what was difficult about it?
I'm looking for a lot of money and people are so excited about my product, they want to invest in the second one.
They don't want to invest in the first one. Why?
No, because they don't want to take the risk.
What's risky? You've got a great product. Right? That's what you told them.
It is, but it's risky.
Why?
There's always a risk.
Okay. How did you
COVID.
mitigate the risk?
COVID can happen.
How did you mitigate the risk?
There's no mitigating my risk. It's going to be a risk.
What's your product?
Indoor golf course.
Indoor golf course.
Indoor golf
Okay.
course, yeah.
How can be any risk?
Well, COVID, nobody would go inside.
True.
That was big.
You need to get together with my other company. One of my other companies called Casper.
Okay.
You know Casper?
I think you mentioned it.
Oh, they have. Casper has a device that they put in the HVA system
Oh, for,
that disinfect all of the, and
I've heard that.
it's a Dallas company, and the offices are over here at Farmers Branch.
that's like,
Okay, so if you had that in your
Yes.
ceiling system,
it'd be no deal.
there would be no issue.
Right.
You just mitigated all the risk. You could say, hey, listen, I'm going in and in my indoor golf systems, I'm going to have Casper system, which is going to clean the air and clean all of the surfaces within my environment, and you don't have to worry about COVID or any kind of infectious diseases or anything else like that. That would have taken care of that, wouldn't it?
Yes, it would.
Okay. Just wondering. Did you have a hand raised?
I
I saw a
was-
hand go up.
I
Is that
think
just
I
saying
know
amen?
someone.
Okay, good. Again, these slides are going to be available to you, so I'd rather have your attention than having watching your heads right. We're going to talk a little bit about venture capital 101. We're going to talk about equity, valuation, that should say option pool. I don't know what an OPQ pool is. Convertible notes, and then we're going to talk about exit scenarios and conversion prices and all kinds of wonderful things like that. All right? So this is for real kind of stuff. So I could spend some time to teach you how to read a P&L, but I figure you guys can do that on your own. I can teach you how to read a balance sheet. You can go do that on your own. I want to really focus in on the things that you as an entrepreneur really need to know. I want to talk a little bit about what we do in terms of as investors. So if you understand what I'm doing as an investor, you'll understand how I'm interpreting what you're saying and what you're presenting to me. Usually I'm going through a funnel. I'm screening to see if your deal fits what we'd like to invest in, because every investor has their own investment thesis. Every one of us has what we'd like to invest in, what stage we'd like to invest in, what industry we like to invest, how much money we want to invest, what kind of returns we need to have. So we're looking to figure out, does it fit our profile? Does it meet basic business fundamentals? Can I understand that you're going to make some money? Are you going to generate good margins? Are you going to make revenue? Do you have a real good go-to-market strategy? Do you have a good team? Do all the team members, are they in place? All the basic business fundamentals. And then legal. Have you structured your company appropriately so I can invest in it? This is where so many companies fail. Why? They believe the hype and they go figure out how to structure the deal on some sort of online, Zoom legal, whatever it is that's wandering around out here. That is not the way to structure your business. It's maybe how you get started, but you're going to spend money down the road to fix your business so that somebody can actually invest in your business. How many of you have an LLC? How many of you have some form of corporation? Why did you choose corporation?
We're going to a Delaware corporation so that it's investor friendly.
Okay, you are?
An LLC en route to a Delaware corporation.
Okay, so at the end of the day, more than likely, you're gonna want to have a Delaware corporation. Why? So people like I can get into the deal. So you can have multiple classes of stock. So you can have preferred stock, which is what I'm going to invest in if I'm investing in your company. Okay? Right?
Yes.
All right. Because if you have an LLC, what am I going to do? I can't get into a price round in your company. So I can't get there. I can go into a convertible note. But how long do I want to be in convertible note as an investor? How many of you know what a convertible note is? Okay, so we're going to spend some time talking about that. We're going to use these exercises a little later on. We're going to look at actual term sheets. So I figured one of the things we do is we actually look at what a term sheet actually is. This is a real numbers are in this term sheet, so we can work with these. Okay? So I want you to understand how VC works. So there's a fund, and I'm a general partner. I'm one of 4 general partners in my VC fund. VC fund's called Prosalis. We invest in healthcare deals. We oversee and manage the fund. We make the decisions about which portfolio companies the fund invests in. The limited partners put up capital into the fund. Okay? And after we return all of the money that the investors have put into the fund, that's when we as members of the general partners can really get to share in the profits. Before that, we are getting a management fee, which usually ranges anywhere between 1.5% to 2% for a management fee for managing the funds. If the fund is really large, that management fee can be significant. If it's a small fund, 20, 25 million, it's really not a lot of money. After we have generated a return of all of the investment in that fund, so if we had a $20 million fund, we return $20 million to that fund, and then after we have put all that money back, then we get to share in the profits, 80% to the investors, 20% to the general partners. Now, you would say, that's pretty good, but it may take years and years to get to that point. So you see that venture capital funds are continually putting money to work and also raising additional funds. What happens if you have a blowout, which means you make no money in your last fund? How hard is it to raise your next fund? Really hard. How much risk does a VC want to take? Not a lot. They want to take educated risk. They want to do risk mitigation a lot. But I wanted to show you this model just so you have an understanding. Funds are usually structured for 10 years. So one of the important things you have to do when you get involved in a venture capital fund or getting with a fund is understand where they are in their fund life. So let's assume that you are raising $1 million. And you come to me and you say, hey, I'd really like you to invest $1 million. And then you find out, I'm in year 7 of my fund life. Is this a good situation for you? Probably not, unless you can know that you can exit in a relatively short period of time. Everybody understand what I just said? Very, very important to understand this. Understand where the fund is in its life. You're looking at me puzzled. Do I need to say that again or say it a different way? Because I want to make, this is something where you really got to understand.
I think I'd be interested in a reframe.
Okay. So, Bo here has got an interesting company. Okay? He's trying to raise $1 million. He comes to me and he says, hey, I'd like you to put $1 million in me. And I'm looking at his company, it looks really good. And one of the questions Bo should ask me is, how much money do you still have? How much dry powder do you still have in your fund? And I might say to him, I still have $5 million. He says, oh, that's good, because I only want $1 million. Then he says to me, if he's smart, where are you in the fund's life cycle? Okay? Very, very critical. Because if I say to him, I am in year 7 or I'm in year 8 of the fund's life cycle, then I don't have very much time to get to a liquidity event for vote. So one or two things are going to happen. Either I'm going to get to the end of my fund's life cycle and I'm going to have to distribute his equity to my limited partners. Then he goes from having one investor to however many limited partners I have. Or two, the other bad thing that happens to Bo, if I'm late in my life cycle, is that I'm rushing him to have a liquidity event before he's fully developed. All right, so you understand why you asked that question, where are you in the life cycle of your fund? With me? Okay.
I know it's going back, right? But why would you decide not to have an LLC versus the other one? Sorry,
Okay.
that's like going back on the.
An LLC can only have so many shareholders.
Okay.
All right, that's one issue. Number two, an LLC can only have one class of security. And in the wonderful world of fundraising, I, as an investor, I'm not looking to come into common stock most of the time, particularly with an early stage company. I want to invest in preferred stock. We know the difference between common stock and preferred stock? Who does? Okay, so most of you don't. Common stock is the basic equity of the company. You get to vote. It can have dividends if they're declared. Preferred stock means that I have a preference over common stock. If there's a liquidity event, I get my money first. Okay? I may also receive dividends when the common stock does not. But most importantly, I'm in what is called a preferred position in the company. So if you have a company, okay, that we've been talking about, your vending company, if I have preferred stock and you get into a hiccup and there's a liquidation, I get first dibs after the bank. Senior debt, then me. Common stock, they wait until see if there's anything left over. So you get the difference, and you cannot do that in an LLC. You have to do that in a corporation. The most common corporations that people use are Delaware corporations because they have the best and most understood rules of any state. It does not mean that you can't have a Texas corporation. It just means that if you're going to be raising capital and you're going to be doing it on a national basis, people understand Delaware corporations, C Corps. Okay? So, why do VCs think the way that we do? 1/3 of the deals that we do, we're going to make nothing on. It's going to be a bust. Another third, we'll get some return. It's really 1/3 or less that we really make money on. So if I do 10 deals, 3 or 4 of them are going to bust. Doesn't matter how pretty or how well I underwrite them. I've been doing this for a long period of time. 3 of them are going to go sideways, not return the investment that I put in them. Another third are going to go decent return, 7-8% IRR. Not really great for the risk that's associated with venture capital. On the other hand, I'm going to pick 2 or 3 out of that bunch. They're going to knock it out of the ballpark and make up for all of the losses, all of the underperformance of all the other deals. So I'm really underwriting very, very hard to get to these big time plays. So now we're going to talk about some financing structures. We deal with equity. Basic benefits. It is so clear when you deal with equity. I'm buying a share of stock for $5. Nothing else, no magic around that. Okay? It's real clear and simple. You understand exactly what you're doing. The structure for the investors is very, very clear. I don't have to figure out what other terms are there associated with this. It's just I'm buying each share is gonna cost me $5. I'm gonna put $1 million in, I divide by 5, and I get to how many shares I'm gonna get. Really simple, very easy. The upside is very attractive to us. It's, there is no short-term payback requirements that are associated with it. And we are all financially aligned. So if Nathan here is the founder of the company, and he has stock in the company, and I have stock in the company, we are all on the same parallel plane. He wants the company to grow, I want the company to grow. We don't have any different deals in the company. That's why equity puts you on the same equal playing field. The drawbacks is that you as founders are giving up ownership and control, or some portion of control. And we'll get into valuation so we can understand a little bit about the control functions. You have developed a long-term responsibility to your investors who now are your shareholders. So now you have a fiduciary responsibility beyond yourself. For those of you who were with me for the board discussion, you know, the board of directors are now representing Nathan and myself. Okay, because we're all shareholders in the company. And the directors have a fiduciary responsibility. The director may be Nathan's brother, but Nathan's brother has to treat me and Nathan exactly the same because we're shareholders in the company. There are some terms that you can negotiate, and it can be expensive to set up. It's much more expensive setting up a corp than it is an LLC. It has to be kept up. There are taxes to be done and other things associated with that. I can spend more time on the forms of organizations at some time if Jennifer invites me back. But just take it, understand that it's more expensive, but at least it gets money into your business. Preferred stock, as I said, gives me a preference over the common stock. And it's where most times I am going to invest in an early stage company. That preference may be a one-time preference. It may be a two-time preference. If somebody proposes you to do a three-time preference, run out the door and just keep on saying no, 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 no as you run down the street. What does the preference mean? It means that if I put $1 million into the company in preferred stock and the company goes sideways and there's a liquidation, I am owed $1 million at a one-time preference. At a two-time preference on a liquidation or an exit, I'm owed 2 times my money. Then we divide up the balance on the percentage ownership that I have and you have. So for instance, let's say that I had a 2-time preference. And if I'm going too fast, just raise your hand, please. I had a 2-time preference, and the company was sold for $5 million. And we had a split, let's say that I owed 40% of the company. I'll just pick a number. So I'm going to get $2 million of the proceeds first, off the top. There's $3 million left in proceeds, and we're going to split that 40% to me, 60% to you. You understand how that works? You understand how that could work to the disadvantage of the founder? So if you're not awake and understand these terms, somebody who is not ethical could really take advantage of you, number one. Number two, I'm going to come back to you. Number two, I always urge you when you're negotiating for capital that you have an entrepreneurial attorney working with you. Not a regular attorney, because most attorneys don't understand this math. I've seen and watched attorneys, and in fact, I basically kicked back documents from attorneys who are very well known, have really, their names across, buildings and things. They send me documents and I look at that and go, do you realize you have basically screwed your client? Because they didn't understand the math, they didn't understand the terminology. Make sure you're dealing with an entrepreneurial attorney who understands these terms, does this for a living, understands how to put together the terms and the structures, because you will end up, this is where you get your payday. So if you don't pay attention to this, it's really on you. I can tell you, people in my position understand all of this. This is how we live and breathe. Okay? So I'm just trying to touch upon it and to give you the thought process that when you do raise capital, do it in the conjunction with an entrepreneurial attorney who will walk you through the right kinds of terms. I see Nancy nodding her head back there. I know, Nancy, you know a few of these folks that can help in this process. Okay. So, we get downside protection. We may have control through voting rights and protective clauses. So in a preferred stock situation, I may have a list of things that you can't do without my approval. I may only own 10% of the company on a fully liquidated basis. I'm going to come back to you. But I may have some things in there that you can't do without my approval. Those are the restrictive covenants that are in there. Okay? You had a question before. I want to make sure I touch it.
In terms of two-time preference, is that a regular thing for VCs, or is that commonplace?
Preferred stock is, you usually receive one.
Okay.
If a VC is concerned that they're making an investment and there's a lot of risk associated with it, they may ask for a two-time preference.
There's 2 times on this sheet.
Okay, I know that's purposeful.
Yeah.
So people will ask for a two-time preference. You really have to negotiate that, and I urge you, do the math. There is something called a waterfall analysis. Have any of you encountered a waterfall analysis? Okay. This is another time coming back to teach waterfall analysis. What a waterfall analysis, it takes you through the rounds of capital that you're going to raise towards an exit. So let's just say that you start off as a founder with 100% of the stock. Then in the next round that you raise some friends and family, and you give away 5%, so you got 95%. Okay? Then you're going to raise, let's say, your seed round, and you give away another 10%. So you're now at 85%. Then we get into your Series A. And Series A, you have given away 20% of your business, of your ownership. Okay, where are you at this point?
65.
65, okay? And then you go into a Series B, and you give away another 12%. You're down to 53, okay? Or it could be more. You want to walk through how many rounds of capital it's going to take you before you get to an exit, to see if you still have control of your own company, A. B, what's your payout going to be? Because I can tell you, if you give me a 2 times preference in the deal, I put in $1 million here, I'm going to take out $2 million before we start sharing. I'm happy as a clam. I'm excited about that. What are you?
I'm not excited.
Okay? That's why we do something called a waterfall analysis. And I teach entrepreneurs how to do that waterfall analysis, because if you don't do it early on before you do raising, before you start capital raising, you can find yourself in a situation that is really detrimental to you as a founder. So you want to do a waterfall analysis. You can look it up. You can find a lot of different examples. CEAF does a lot of that. SEARF, CEAF, has a number of examples of waterfall analysis on their sites. And they have actually a model that you can plug your numbers into and work with that. So a good resource for you. We may also have as a clause in there that we can get dividends, we can get other upside benefits associated with the company, as well as participate in anything that common stock gets. So know your terminology, and when somebody comes to you and says, oh yeah, I'll put $1 million into your deal, how? Let's start talking about our term sheet, which is why you got term sheets in front of you. We're going to visit with them about how you structure your deal. When you are doing your equity deal, one of the most important things you want to do is think about valuation. How many of you have raised capital? What was your valuation?
At the time, it was 3 million.
Okay, how did you get there?
Asset, financial, what our projections, and basically the value that.
So you took it out of the air?
Yep,
Okay,
I mean, that's
honest.
where you take it for a start.
Okay. All right, that's an honest response. That is not the right response, but that's an honest response. How are you valuing your company?
Looking at our competitors and looking at our financial projections.
Okay, discounted cash flow? Okay, that's one of the ways you can do it. All right? You're gonna look at what kind of security class are they coming into? Are they coming into common stock? Are they coming into preferred stock? What are the terms that are associated with there? Is it liquidation preference? Is there board representation required? If I'm investing $1 million into your deal, and you tell me, hey, hey, I'm glad to have your $1 million. I said, by the way, I need a board seat. And I have this liquidation preference, which may be 1 times, 1.5 times. I need a board seat. I'm going to have voting rights that are equivalent to the common stock. So I'm going to vote as if I was converted. Okay. I'm going to have information rights. Now you have to share key information about the company once a quarter with me. I have right of first refusal. Why is that important? Anybody know what it is? Okay, you do? All right, so what that gives me is the first right to put additional money into the company. Why is that important? Well, for me, I want to keep my position. If I own 23% today and there's a new round of capital coming in, I want the right to continue to have 23% in the company. Okay? Very, very important. Anti-dilution provisions. Try not to ever let an investor talk you into that. Who knows what that means?
So that it's favorable for the investor because then they can slowly take ownership of your company and you realize that.
Well, I won't say it that meanly.
But I mean, as an investor, like, why would I want to buy into the company if I buy 10% now, but you gotta lose the shares so much? I own like 0.1% down the line. Like,
If you become a $20 billion company, do I care?
I'm $2 billion company, yeah, I still care.
Well, here's why you don't want somebody to do this, because what that will do, it'll do 2 things. One, what it says is that if I have 23% now and you're going to do another round, and I don't put another dollar in, you're going to have to give me enough shares from that next round to keep my 23%. That's a disaster for you. And guess where that's going to come from? It's not coming from the new investors who are coming in. It's coming from the founder's pocket.
But as an investor, why would I want to buy anything if I can't keep a constant percentage?
Because you recognize you've done the waterfall too, and you can figure out how much money am I going to put in. And as an investor, I'm diversifying my portfolio because a third of it's going to go in the toilet. And I don't know which third is going to be in the toilet. So I don't know if I want to put more money into your deal. I'm facing that decision right now. I have to decide by Tuesday if I want to put more money into an existing deal.
Yeah, I have a decision on investment too, and I don't think I do without anti-dilution provisions. I mean, it makes sense if I put in this money, I can maintain.
But here's the other thing too. If I'm the new investor, and if you're the new investor and I have anti-dilution, or you're the old investor that has anti-dilution provisions, and I'm the new investor, I take a look at that and I go, I'm not investing in any deal where he can get to maintain his position without new money, and I'm putting all the new money into the deal. I just won't invest. So be very, very careful if this is ever proposed to you. Okay? And then there's the whole issue of dividends. Not only if there are dividends, what size dividends there are, and when they're paid. Some preferred stock can also be convertible. Some preferred stock can also carry interest with it. So you have to be very conscious of all the terms that are being proposed. And the more money you're raising, the more complex the terms can be. raising $100,000 is pretty much plain vanilla. You're raising $1 million or more, we're going to get into some discussion of terms. So, let's talk about valuation. Pre-money versus post-money. Who wants to define it? You can't read it. Pre-money valuation. One of the most important things, pre-money and post-money valuation, one of the most important things that you need to know as an entrepreneur. Pre-money valuation. I'll pick on you because I know you know the answer.
How much your company is worth for an investor in your own position.
Okay? So, you said that your pre-money valuation was $3 million?
No, that was hard.
That was
Okay.
me.
Okay. What's your pre-money valuation? I can't remember what you told me.
Still up there, but it's about 2.5.
$2.5 million pre-money valuation. She did some discounted cash flow, she got to that point. That's what she's trying to convince me. I think you were trying to convince me a couple of months ago. A couple of months ago, she was trying to convince me her company is worth $2.5 million. This is a real conversation. For real, okay? And you're trying to raise, how much was it?
$250,000.
$250,000. So she was looking to sell about 10% of your company. A little bit 8% of your company, 8% of her company for $250,000. So pre-money valuation, what it's worth before the investor puts money in. The raise is how much money is coming in. Post-money valuation is the combination of the raise and the pre-money valuation. Okay? Why is this important? Determines how many shares you get, or what percentage of the company you own. So, $2.5 million, if I put $250,000 in her company, and I believe her pre-money valuation, that means post-money, I have about 8% of the company, I'll get 8% of the shares. Okay? Easy enough math? Okay? Which says, depending on what stage she's in, would I do a deal in her industry, in what she has built up to this point, for a valuation that gave me only 8% of the shares at this stage? That's another conversation that we'll have. Okay? Does everybody understand pre-money valuation, post-money valuation?
My valuation has changed.
Can you go down?
It went up.
This is called a negotiation. Okay? Does everybody understand valuation, pre-money, post-money, and the raise? Because those are terminology that you have to understand if you're going to be an entrepreneur and you're going to raise capital.
I have a question.
Yep.
Could you ever buy companies as percentages, which would really be undiluted shares?
Could you buy companies as percentages?
I want to buy 3% of this company, 3% forever. I mean, that would essentially just be buying undilutable stock, but is that common or is it rather uncommon?
I've never heard of it.
No.
No. So you would have to have anti-dilution
Yeah.
provisions in play, and you would either have to have a first right, which means you throw some more money into it, or you'd have to have a situation where you got anti-dilution and it means you pissed off every other investor who's going to come after you. Because if you have anti-dilution in your investment and I don't, I'm going,
Yeah.
why?
Is that something that has to be disclosed?
Yes. Excuse me. Don't do business with him. You have to ask the question, does it have to be disclosed?
No, I was just going to say, he's asking a lot of really great questions.
Because
I may want to.
you want to do business with him.
Yeah.
Okay, he's shady.
I'm currently thinking about investing in a company, but if I couldn't maintain a 0.1%, then no, it's not remotely worth the calculus to me.
So can you spend percentages or do you spend dollars?
Spend dollars.
Okay, so I have equity in Apple. I bought Apple when it was $48 a share. Before it split a gazillion different times over the years. Do I care that I own 0.0000001% of the company, or I'm happy because my $48 a share purchase is now worth whatever it's worth, because the valuation of the company has gone up so high? I'll give you your 3% of the company, and you can have that forever, but you just never participate in any valuation increases, okay? Oh. Well, no, you're not gonna get forever anti-dilution protection. I'll give you first right of refusal to participate, so you can come in and put more money in the deal, but I'm not gonna give you anti-dilution forever for nothing. Here's what I would do. I'll make you a deal. Okay? Your company, you said is pre-money is 2.5, let's just pretend that it's still there, because I think that's probably where it is. So I'm going to send you 3% of the company, but my valuation today is $50 million. Are you okay?
Well,
Excuse me. Get his money.
I mean, well,
No, I said, get his money.
Well, I mean, what, am I stuck here though, or am I going to increase the valuation? But honestly, what's confusing me is...
No. I'm selling you, you're going to put $250,000 into her company, okay? And that's going to give you, let's just say it's 3%, okay? But my valuation is at $50 million, not the $2.5 million. You're going to buy it at $50 million valuation. I'm going to buy it at $2.5 million.
But I mean, isn't that, if I'm taking that much risk in the early stage to give you seed money or whatever, then that's the payoff. If I can buy a fixed percentage and it grows like a lot, then that's worth it to me. If not,
If you can find somebody who's foolish enough to give you a fixed percentage, which is anti-dilution forever, and not have to put any more money into it. First of all, if you find somebody who will give you an anti-dilution provision, really figure out if they know how to run a company, because they really probably don't.
yeah.
Okay? I'll come back to that, but that is somebody who really doesn't understand the math of actually how you grow and value the company.
They don't, no, they definitely understand the math. It's not likely, but wish me luck, I'll still try.
Okay? So, Series A investors put in $4 million into a $6 million pre-money. Okay? 60%, 40%. Everybody understand the math? Can you see it there? This is about as simple and plain vanilla as I can make it. You end up with a post-money of $10 million, and it's split 60% founders common, 40% Series A preferred. Pretty straightforward. So now we're going to talk about valuation methods. Discounted cash flow. I know somebody who used discounted cash flow. Okay? Tell me about the parameters of your first of all, tell me what discounted cash flow really means.
Yeah, so I'm gonna say I don't know.
Okay.
But my finance person that has been walking me through, my COO that has been walking me through this, I should know, but I'm not.
So how much has she just diminished her image in the eyes of an investor? The first thing was my primary valuation method, which is discounted cash flow. And I said, so what's discounted cash flow? She says, I don't know. My finance person, okay, inside, outside, don't know. She then said her COO, okay, so it's somebody at least under the 10. But the founder of the company does not understand how she arrived at valuation. What does that do? What confidence does your investor have in you now?
None.
Okay. It diminishes your leverage. It just did. Why? You have to understand the basic math of how entrepreneurs work and the valuations of their company. Most people think about, and I'll come back to just a second, most people wonder about the sales and operations of your business, and that is about 50% of your job. The other 50% of your job is how do you generate value in your company. If you're not generating value, all you did was buy yourself a job. That's all you've done. So you have to be able to understand how you continually build value in the company, or else basically you're working for yourself. You're self-employed. And that's about all you got. You got nothing that you can sell. All right, discounted cash flow. A bunch of formulas up here. It basically says I'm going to discount all of the free cash flow over some period of time and bring it back to the present, and that's the value of my company. So what I'm doing is I'm taking the revenue and profit projections, figuring out how much cash they're generating over a 5-10 year period. I'm applying a discount factor. We won't have enough time to talk about discount factors today, but you apply a discount factor and then you do a net present value to today. And that'll give you a valuation. Now, here's a challenge. Garbage in, garbage out. I've seen a lot of people put together a lot of projections that don't mean a thing. They have cash flow projections that are meaningless. They use discount factors that don't make any sense. Okay? Very, very important that you understand how discounted cash flows work for you to be able to use it in your valuation. Because I can tell you that if you sit down with me and you say, my company's valued at $2.5 million, I'm going to say, okay, how did you get there?
But aren't there multiple ways that you can value, and this is only one way, right? You can do the multiples and.
Okay? That's the next method. So we're going to go to 3 or 4 methods of how you value your company. And again, these slides are all available to you, so you can utilize this. So, there's a philosophy that centers around the extreme risk taken by an investor and to provide an opportunity for the investment to achieve a 10x increase in value over its life. Let's just say that the average valuation for her industry at her stage in her particular product is $2.5 million. Imagine how we got that. Okay? So, has she reduced product risk? Add up to $500,000. Okay? Prototype is already in place. She's reduced my risk, my technology risk, another $500,000. Reduced my execution risk, $500,000 by having a really strong team. She has strategic relationships, and she has rollout or sales already in the marketplace. So for each of these factors, I can add another $500,000 to her valuation. Let's go the Berkus model. So I take the average of what's happening in the marketplace, and then I add goodies to her valuation based on what she has done. These are very, very important. So, good idea. Okay. She has a prototype already in the marketplace. She has a quality management team, which she does. She has a very good management team. Strategic relationships, yeah. Product rollout or sales. She's already in the marketplace. She's post-revenue. All those things add to what the average valuation is in the marketplace. You had a question before.
I was going to answer what was like a discounted cash flow.
You wanted to go back to discounted cash flow?
No, I was going to answer that question when you asked someone to explain it.
Oh, you know? Oh, that's right. You're a finance major.
Yeah.
Why don't you explain it?
Pretty much you said it. Like I think $1 today is worth more than like $1 in 10 years. So that's why.
You discount it.
Yeah.
Okay. Does everybody understand the Berkus method? So if she got all these goodies along the way, that could add another $2.5 million to the deal. She could double her valuation because she's something special in the marketplace. So much better than everything else that's in the marketplace. Got it? Yes?
So would you then do a combination of the discount cash and the Berkus method to get to like double the valuation or something?
You do the what I do is I do valuation by a number of different means. So we go to the scorecard method. This is one of the things that my team does. We have a proprietary scorecard that we measure across about 14, 15 different areas. And we determine how strong the company is, and we assign points to that company. And if you score on average, you get the average valuation in the marketplace. If you're above average in the areas that we care about, you get a higher valuation. So if you're an average company and the average valuation is $3 million, you're going to get a $3 million pre-money valuation from us. If you have your post-revenue, you have a team that has done this before, and you have industry and business expertise, you may end up with a $4 million valuation pre-money from us. And let's say I did this, you're scoring high here. I did the Berkus measurement, you scored high there. I did discounted cash flow, you're scoring a little lower. I'm going to combine a series of those to get to a valuation. Oh, sorry.
So I know investors and VCs are really looking for like a one-man show. So when you're saying strength of a management team, can you kind of just give an outlay of exactly what you're looking for?
Does your management team have domain experience? So you're in the vending business. Does your management team have experience in the business that you are trying to go into? Do you, for instance, you're developing apps in the vendor experience. Do you have somebody on your team that really understands the vending experience, industry? Do you have other people in your team that understands the development of apps? Okay? Do you really have a success track record in going to market? Do you have a really strong team who has had previous exits before? That's what we're looking for.
How did your team come up with the weights for each criteria? Percentages.
These are made up, but for us, we went through our 13, 14, and we assigned certain percentages to team, market size, and for us, since we're doing a lot of work with healthcare deals, where that company is in the regulatory process with the FDA. All right, and then the adaptability of the product, whether it can be used in the hospital, the doctor's office, and home. So we have different kinds of rates. Yes, ma'am.
Something like this, would that be further down in the process, maybe after the pitch, after like you've kind of solidified that there's interest with the VC firm, then you, what is the typical process of going?
Okay, so in your deck, you're going to have usually you'll have a proposed valuation.
Okay.
All right? You say, I want to raise $5 million. And I'm going to do it at a pre-money of X. That's when you're really smart, because that'll move the conversation. You know essentially what you're thinking and you're looking for. If you give me, I want to raise $5 million, and you don't tell me anything, I don't know whether you're trying to do it in equity, in a note, I don't know what kind of valuation you're looking for. So that means I got to go waste time. Because I get 12 decks a day across my desk, easily. So the more you can tell me about what you're thinking in the shortest number of pieces of paper, the better. Do not present a deck 20 pages. Nobody's going to read it. 10, 12, probably the best range of decks to put together. You're trying to get my interest, not tell me your life story. Okay? The other way that people do is return on investment. This is something that people don't use that often. It relies on calculating a return on investment based on your overall portfolio. It's a little more complicated than most, and I don't think many firms are doing this very much anymore, because they're looking at deals on an individual basis as opposed to just figuring out where it fits in their portfolio and sticking a valuation on it. I want to talk to you about option pools. People know what an option is. Who knows what an option is? Okay, so many of you do not. You know what an option is? Describe an option.
Is the right, not the obligation, to buy or sell the share at a time that you discuss.
Okay, so an option is a right. It's a right to acquire a share at a certain strike price within a certain time frame. Options are usually provided to employees of an organization. So you're bringing on a key employee, you want to make sure that they're aligned with you. You may give them some options in the company. Those options have to be exercised within 3 years, or they may vest. Who knows what vesting means? Okay? Vesting relates to what portion of the options are going to become usable at what time frame. So for instance, I recently got into a deal where I had, let's just say, 50,000 options, okay? They vest over 4 years, and they vest a certain percentage each year. That means those options are now mine to use over that time frame. So in the first year, what's for, was it 1.25, 12,000? I'll just say it's 12,500. 12,500, those options are now available that I could use, and I could exercise at a certain price to buy stock. Okay? Everybody clear on that? Anybody not clear on that? You're not clear on it? Okay. And I like your honesty. All right? So, you became an employee of a company. Or you are the owner of the company, and you've given this young lady 10,000 options. And they are exercisable, or they vest over 4 years. So 2,500 each year become hers to be able to use. All right?
So those are translated to stock, options is translated to stock?
They can't, what they mean is she now has a right to buy 2,500 shares after the first year, 5,000 after the second year, 75, 10,000 in the fourth year, okay?
So that's additive?
Yes, they're additive. So at some point, let's say after this year, she has 2,500 that she could exercise at a certain price. Let's say you valued those options at 50 cents a share. She could give you $1,250 and she could go exercise and have those shares in her name. Okay? Everybody understand the math? Okay. And that's one of the ways that you get to keep her aligned with you and the company. Because she is now a potential owner in the company, and if she does what she needs to do in the company should grow. As opposed to just being an employee. It's one of the things that you do for your employees, and sometimes for your vendors, to keep them aligned with you. You don't have cash, you can give them some options. But you use your option pool sparingly, because guess where those options are coming out of? You. Okay?
So if you don't use it that first year, can you just buy everything for the second year, for those 2 years?
You could.
Okay.
You could, because they usually have a life. The options may be usable, exercisable within 5 years or 7 years.
And after that, it's...
They're gone. So normally you put together an option pool. For most startup companies, I usually try to say to them, reserve anywhere between 8 to 12% of your stock for options for your employees. Put together a pool. Okay? It's called an option pool. And you reserve those options for your employees, vendors, your directors, your board of directors. This is where how you incent your board of directors. You give them options. So I have options on a number of the companies that I sit on, where I have options that vest over a certain period of time during my board term, and I can exercise them at a certain price. Okay? Now, let's see if there's anything else I want to say about options. I think that's probably all I want to say about options. Let's talk about convertible notes. How am I doing on time? Because I don't usually look at time.
3 o'clock.
How much more time do I have? What's on the back of the paper?
3:15.
All right, I got 12 minutes. How many people know about convertible notes? Okay, most of you don't. Another way you can raise money for your early stage company is in a note, debt, as opposed to equity. Most of these are called convertible notes. They have the right to convert from a debt into equity under certain circumstances. So, I may invest $250,000 into a note in her company. All right? And that note will convert at the next time she raises a price round. Let's say her Series A round. Okay? And it may have in it that it will convert if she raises $1 million in capital. All right? And it has two provisions associated with it. And this is where you have to really pay attention. I am really interested as the note holder as to what valuation I'm going to convert. So I may set a cap on that conversion, or we may agree to a cap. She thinks that she's going to be able to convert, her next round of capital is going to come in at $10 million, okay? And I think, oh, that's a little bullish. I like to set a cap at $7 million. And let's say we get to an agreement of that. So the next time that she goes out and raises money, and she may be very successful, she raises $1 million at a $10 million valuation. My money is going to convert at the lower valuation, at the $7 million valuation. So that's the value of the cap. Now, there's a second thing I'm going to negotiate, and that is I'm going to negotiate not only a cap, but because I'm taking a risk with this company and just giving you debt that's not paying interest probably at this point, I'm going to ask for a discount. So I'm going to say to her, I'm going to say, I want a cap of $7 million and I want a discount of 15%. I really would ask her for 25, but I'm trying to be nice in this room. So I'm going to ask her for both of those things so that when she goes to and sells $1 million at $10 million valuation, I'm converting at $7 million. I'm not converting the $250,000 that I invested. I'm converting the $250,000 plus the 15% at my discounted cap rate. That's what an investor is looking to do with a convertible note.
It's the $7 million that you locked in, right? Yeah.
All right, so I'm converting it at that cap. I'm doing whatever the math is, 250,000 times, 1.15. Okay, so I'm converting at 300 and something, whatever it is, and I'm getting more stock. So that's the trade-off with a convertible note. It usually has an interest rate. By the way, that interest, whatever interest I'm earned, usually isn't paid. It's usually thrown into the conversion. Okay? There's a maturity date, usually 6 to 18 months. So when she issues a convertible note, she needs to know, hey, this thing better convert at some reasonable period of time. There's a qualified financing. She may set that at $1 million. We may negotiate that. Is it $1 million? Is it $2 million or whatever? There's some benefits. Discount rate, cap associated with that.
So basically, you could earn interest, you want to get it done before that 18 months, and you could have a discounted rate of going into the convertible note once you get the 7 million.
Right.
But as a founder, I don't give up equity,
No.
and I get you off my cap table with that.
Right.
And the interest just rolls into the...
Yep. So more than likely, your first real financing is going to come using a convertible note. That's the sort of the way of the world in entrepreneur land.
As an investor, do you also use that same kind of entrepreneurial attorney? I know it's good for me if I were a person who are interested in getting someone to invest in my company, but we're learning about what both sides of that looks like.
Mm-hmm.
So would I also use that same kind of attorney as an investor?
You mean if I was an investor investing?
Right.
Well, if you were new to investing, yeah. But I've done this so many times. I've written the notes. I can draft all the documents.
We just call you on that number that you got.
Are Delaware C Corps also preferable for convertible notes?
You can do an LLC. It doesn't matter. And the reason being is there is no. You're not getting into the equity cap table at this point. So there's no second class of stock. Yes, ma'am.
So convertible note, in the essence that I can pay it off in like the maturity date, you don't get equity, right? But-
You could pay it off, but I may have some clauses in there that are not so nice.
Okay.
All right? But I might be saying to you, all right, well, if you don't have your conversion within this time frame, you have to pay me 2x of debt. Because my interest, when I'm doing a convertible note, I don't want to stay in debt. I'm not interested in being a note holder to you. Note holder doesn't do anything for me. There's not an interest rate you can give me that would make me feel good.
Really?
No,
What if it's 20%?
I still wouldn't feel good. Okay? Because I'm looking at a 10x exit. You can't get me to 10x, that number. So I am trying to get to the equity cap table. Preferred shares preferably.
What other kind of restrictions can you put in there as an investor, try and pressure the company to convert you?
Well, actually, you don't want to do that. I want to, when we do a transaction, I want to get on your side of the table. So I want to do everything I can to encourage the success of the company. So I don't want to put tricks into the deal. I've seen people who do that, but once you got my money, you got me. So we're now on the same side of the table, and we're going towards trying to figure out how to build a company.
Because requiring a double the debt payout sounds like a pretty punitive.
Well, what she has said to me is, I am going to have a conversion, I'm going to go raise capital, and I'm going to cause about this conversion, because really you're sitting down there, you're not really, I got money tied up.
Yeah.
I'm not making anything on that money. Like, it's an interest rate, you can't do anything to give me equity returns on debt. So I'm sitting in there just sort of twiddling my thumbs. If she does nothing in 18 months and we get to the point where the maturity time period is over, I have the choice usually to convert, okay, at probably a lower
Or at
rate.
least to get a 1x return.
Right. Okay? Questions about convertible? How am I doing on time? I know I'm running out.